There's a genuine delay from our side. Internet is something which you want to think it is reliable, but trust me, sometimes like वो रामायण में कहा था ना कि करण अपनी शिक्षा भूल गए थे इम्तिहान के पहले. So one of those days I was not able to log in. So I guess next 1 hour it's going to be action packed. We've got the five horsemen of Indian stock market, some of the smartest stock pickers in a bull market. Now let's see, they will tell us that in a bear market, how can we survive the storm? There are 3 words which we have used very, very actively over the course of last 2 months. First is unprecedented. Second is volatility. Third is risk. And fourth, large extent, is panic. But I like to add another word in everyone's vocabulary, which we don't use in a bear market like this. And that is opportunity. So the course of next 1 hour, that's what we'll focus on. How to convert risk and scenario into opportunity. We'll keep a mix of Hindi and English both. Vijay ji has written a poem in a bull market, but before the poem got ended, it has become a bear market. So we'll sing a lot about that poem. Manish Sonthalia will pour in his experience of quality stocks. Pankaj Murarka is the happiest person in this panel because he genuinely does not need a haircut right now. So in this kind of a bull market, while some of us are looking for barbers,
Barbers will find it tough here. They will give you a waiting period.
First time I'm actually happy to lose hair. And when it comes to a lot of us, well, the haircut has already happened in some of the portfolios and some of the mutual fund portfolios. So with that note, I'll start with a very simple fact, which is that good news and good prices that rarely comes together. It's this webinar is all about stocks. Normally when we do a stock discussion, we have disclosures at the end of the session, but I'm going to keep disclosures right at the top of the session. This is not recommendation from any of our experts. This is a pure knowledge sharing chat or webinar which we've created. Some of the stocks which will be discussed and identified by a panelist. Please do your own due diligence. Everyone has a different risk and a different profile. So Manish, let me start with you. In this market, where according to you, there is opportunity, low risk, and what markets are currently perceiving as risk, according to you, is a great entry point for a long-term investor?
Yeah, so, sorry. I think, in these current market situations, the one thing which is required is bulletproof balance sheets. And today, because of the liquidity problem, if you have high leverage on your books, that's going to be a killer. According to me, any sector, which has a bulletproof balance sheet or zero leverage companies are going to be in a much better position than leveraged companies. That's one. And their valuations will also show up. But if you talk about where is the safety today, I think the biggest safety today is in creating a defensive portfolio because it's a risk-off environment. I mean, and because we are managing public money, obviously you got to balance both risk and return in the current circumstances. I believe opportunities are there in the consumers' names, as has always been the case, more with staples, pharma, and your IT names. I think these are the names which I will favor. And within the financials, I would broadly ignore the lending institutions, which is your likes of your banks and NBFCs. They have corrected, but they can correct even more because nobody really has a good handle on the credit cost on NPN situation. Within the non-lending institutions, I think I like all the broking companies and I like all the insurance companies. So it's a pick and choose in that space. So that's broadly the area of safety for me.
Achha. So Manish, your first pick which we'll discuss is HDFC Life.
Yeah.
Why do you like HDFC Life? Do you think the whole medical crisis will force everyone to use words like care and concern for their family? Do you think insurance, which in a sense was getting ignored by millennials who are using more money for travel and less for insurance, that mentality will change? When there is fear, that is the time insurance does well. Is that the reason why you like HDFC Life?
So this COVID-19 issue has done one thing. I think in the minds of everybody, healthcare and lifestyle is going to undergo some major changes. And even before COVID-19, broadly, we had a protection gap in India, and we compare ourselves with Southeast Asian countries anywhere, Singapore, Malaysia, etc. We are quite underpenetrated. And why HDFC Life? For the simple reason that it's a trusted name. HDFC has broadly built its name over many decades now. They life insurance business is consolidating. The public life insurance companies, basically your LIC, is losing market share, and the entire private life insurance companies are getting settled and whittled down into 6 names, the top 6 names. They broadly have more than 70% market share. So one reason, you have a protection gap. There's also a savings need. Third, there's consolidation. And in HDFC Life, what we see is that they have product innovation. They are leveraging technology to the hilt, and they have a very good distribution. Of course, HDFC Bank gives them that advantage, but even otherwise, they can actually leverage on their bancassurance channel as well as tie-ups with other insurance channels. All these 3 factors, and now you can also have health indemnity come through, and that can be provided by life insurance guys as well. I think the value of new business premium growing at 15% for the next decade is very much possible. It's not unlikely. And within that, HDFC Life obviously will have its market share. They are well capitalized in terms of your solvency. Operating variances are the best in the industry. 13th month persistency, 61st month persistency are at very good levels, so to speak. All these factors allow them to command a 40% premium to other life insurance players. Even if you assume that this premium comes down, a 15% earnings growth will mean that it's going to be a wealth creator in the next 1 decade. And these are the prime reasons why I think HDFC Life is a no-brainer when it comes to a decadal investment stock.
Okay, now guys, we are talking about decades. So these are stocks which are not our stock ideas, which our panel is not identifying for tomorrow morning. These are stock ideas. This first one, which we've identified, is Manish Suntalia. You can see, why Manish is bullish on HDFC Life. That's a Bloomberg chart, which you can see on your screen. And that's one which Manish Suntalia feels could be valid for next 10 years. I'm going to go in terms of seniority here, and perhaps age could be the reference point. So who is the senior most in this panel? Yes, Vijayji. I'm using age as a benchmark here. So Mr. Kedia.
Does the webinar actually started with you only, Nikunj bhai? Chalo.
Okay. You like Z.
Yeah,
I normally, I love to discuss media stocks.
Yeah, of course, in this case, for the obvious reason. Yeah.
For the obvious reasons, I claim to understand media slightly better than a lot of people. But why Z?
Hey, let me tell you, first of all, I'm not saying that I'm going to hold Z for next 10 years. Okay, that is not my intention. Because I had some cash and I found that stock was 1.5 years back, it was just 600 rupees. Now fell to what, 120 rupees. Okay. And there is no change in the company. So far fundamentals. Hello?
Yes, please. We can hear you.
Yeah. So far fundamentals are concerned, there is no change in the company. Forget about the management part and all. Now management is holding only 5%, 80% held by all the Ps and investors and all. And still company is making 1,200, 1,500 crore rupees every month. Every year. So at the 13,000-14,000 of valuation, you are getting Z. So I thought, I don't think that there is much downside from here. I bought at 120 rupees, 120, 25 rupees. Luckily, so I don't think there is much downside from there. And now, since, as you know, that they have invested into that Marg, what you call that sugar box and all. So if suppose that project of there actually becomes successful, then I think the valuation of sugar box in itself will be exorbitant. So in the current scenario, I have bought some shares, but I'm not saying that I'm going to hold for 10 years as of now.
Okay. I'm going to go to Sandeep Sabharwal. He's got an interesting pick here. And Sandeep, you like Britannia. Now we're talking about 10 years here, Sandeep. 10 years to invest in Britannia, a stock which has not corrected at all in this market. Are you getting carried away by the near-term visibility? Because right now we are consuming essentials and staples, and hopefully after 10 years also we will consume. But Sandeep, it is often said that if you buy a good company at a bad price, you will not make returns. So if somebody is buying Britannia, is this a case of buying a good company at a bad price or exorbitant P multiple? Sandeep Sabharwal.
Yeah, Nikunj. So I think we need to put this in perspective. So my perspective of India today is that given the way the economy and the government of the day is responding to whatever is happening on the COVID crisis and everything, I believe that India will enter into a phase of relatively lower growth for the foreseeable future. So we will have obviously 1 year after this crisis where the economy bounces back significantly. So it might be 7-8% growth, or can be anything, because when the base is zero, the growth can be anything. But ultimately, I think given the connotations and given the damage to the economy, I think longer term growth prospects for India have declined significantly. So in this context, what will hold on is more of consumption. And consumption is the space where, because of demographics, because of population growth, because of aspiration, the people will keep on consuming. Now, price is a choice which people need to make, because I am also a proponent of timing the market and time in the market. So actually, when I picked up this pick and I sent it out, the stock was actually 15-20% lower. So after that, it's rallied, it's reached almost 52-week high. So people can wait it out. The stock can potentially give up some gains if the markets give up gains. But over the long run, given the product profile of the company, given the way I think consumption will play out in India over the longer run, given their product basket and the way they have innovated products, and given their market presence and the balance sheet strength overall, I do believe that this company will keep on going from strength to strength. Like you said, in terms of valuations, today valuations are not in our favor for the immediate term. So the stock could potentially give up some gain. That would be the time you could get in. But longer term, I believe it will create a significant amount of wealth for investors.
Okay. We're getting lots of questions. As we speak, there are about 645 participants on this platform. We've got a record capacity here. It's increased to 647 as we speak, so people are tuning in. This, of course, is going live on Facebook and other platforms also. The entire webinar would be available on various platforms of ET now. So in case you've just tuned in, and in case you missed the first idea from Manish Sunthali and Vivek Kedia, I'm promising you that that would be compiled and that would be shared. Pankaj Murarka, InfoEdge. I want to understand that why do you like InfoEdge? Do you like InfoEdge because they own Naukri.com, or do you like InfoEdge because they have investments in Zomato.com and Policy Bazaar? Whatever may be the reason, Pankaj Bhai, right now, InfoEdge का समय खराब है, नौकरियां जाने वाली हैं और लोग स्विगी और जोमेटो पे खाना खाने हैं.
Yeah, you're right. So that, the true test of a business is when it goes through a difficult environment, when you have headwinds against the business and how well the business navigates that. That's a true test of a long-term resilient business. I think for me, when we're talking about 10 years and so on, it's important to understand consumer behavior and trends over a 10-year, 20-year period. And my firm belief is what Jio has done is something really revolutionary in India. By taking data prices, post the Jio coming down, data prices in India has fallen by 80%. And while last 2 years or 3 years, the economy has not done well, one of the biggest growth that we've seen in the economy is in data consumption. Where data consumption has actually gone up 7 times in the last 3 years. An average user who was consuming under a GB of data now consumes about something like 10-12 GB of data. And yet his cost of consuming the data is much lower than what he was paying for a GB of data. As a result, what we've essentially seen is smartphone penetration in India has gone from 30% to something like 60%, and over the next year should go to 80%. So I think what it essentially has done is laid down the seeds of a completely new economy, which is the internet economy. What technology and internet has done in the Western world, in the US over the last 15-20 years, I think we'll see that happening in India in the next 10 years. And InfoEdge across its businesses, whether the own businesses which they run themselves or through the investee companies, cuts across everything that's around internet and technology. So obviously they have these 3 core businesses, the 3 basic needs of life. As we say in, when I was growing up, I learned was once you qualify or once you pass out, first thing, as you rightly said, you need is a Naukri. And if you need a job, you have to visit InfoEdge, because they have the largest job opportunities for any candidate or any prospective candidate looking for a job. Once you get a job, then the next thing you need in life is chokri, to get married. And they run a They run a matrimonial business called jeevansathi.com. Given India's demographic, we need to have about 10 million marriages that happen every year. I don't know how many people know. Marriage itself is a $40 billion industry in India. It will keep growing at double-digit growth for the next 15-20 years by the sheer power of our demographics. And matchmaking is not easy in a complex society like India, where we have the so many sects and dissects. So I think Jeevan Sathi, I think plays around that, and I think there's a huge. I feel very optimistic about their business prospects. And once you've got both of them, finally, what you need is a makan or a house to live in. And again, they are the cutting edge of it with a business called 99acres.com. So I think all three of their businesses are something which every Indian will, at some point of time or other, will need, and probably if even 30-40% of Indians turn their customers, I think the potential value of the business or the earnings power of the business can be humongous. And as you rightly said, on top of that, they have some of this investment which have done very well. Zomato is now a fairly established business with the food delivery platform, and they have while they've made lots of investments, some of them have not worked, but the two which have really scaled up is one, Zomato, which all of us use, and I'm sure it's become a very large platform now, and the other one has a lot of potential, I think, is Policy Bazaar, because as at the cutting edge of fintech and as technology intervenes into the financial world, Policy Bazaar is is across all the, or is getting into all the platforms of finance, and I think they have a huge potential there. So I think when I look at it from when we're talking about next decade or something, I think I find that all the businesses that this company runs are still very nascent, and the growth potential could be very, very significant.
So मनोज कुमार की पिक्चर में बोलते थे रोटी कपड़ा मकान, आप बोल रहे हो इन्फ्लुएंस लेना चाहिए बिकॉज इसके लिए आपको मिलेगा नौकरी छोकरी और मकान,
रहने की टोकरी.
They have a price target for InfoEdge, Pankaj, and do you own it? Let's get a disclosure before I go to Vikas Kiman.
Sorry, is that for me?
Haji.
So I missed
you have a price target for InfoEdge.
See, I've been owning this stock for the last 12 years, okay? Right from the time it got IPO'd. Every time I set up a target, the stock goes 40% or 50% higher than that within the next 12 months. So all I'm saying is, who thought after the technology meltdown in US in 2001, Amazon was available for $2 billion. No one thought that it will turn to $1 trillion company. When you're buying high growth businesses and you're buying for a long period of time, the prices can really surprise you. Why should you cap your upside by putting a target to it? Let's just keep it open.
Because I'm tempted to come to you, but I've got a question coming. And the question is that Vijay Kedia is a mid-cap maverick. He's bought stocks like Sudarshan, Atul Auto. How come Vijay Kedia this time is talking about buying Z, which is a large Nifty 50 stock? कहाँ गए Vijay Kedia जो mid-cap stocks लेते थे? कहाँ है वो? ये मैं नहीं पूछा. People are asking it, Mr. Kedia.
सर जवाब ये है कि दिल के अरमा आंसुओं में बह गए, हम वफा करके भी तन्हा रह गए. तो बात ये है कि अभी मिड कैप को देखकर ऐसा है कि मेरे को ये समझ में आ गया कि अल्टीमेटली मिड कैप मींस व्हाट. मिड कैप इज ए lot of shares in mid cap. I'm talking about small cap and mid cap which are not liquid. Okay, so those are like, I realize those are like snake and ladders. You buy one share at 100 rupees, it goes up to say 500 rupees also in 5 years time. But by the time bull market is over and you want to sell your shares, you won't be able to sell the shares and stock price falls down to 200 rupees. And 50,000 रुपया का शेयर आप बेचने के लिए जाओगे ना, that will spoil the market cap of 50 crore rupees. 50,000 rupees can spoil the market cap by 50 crores rupees. So I realized, and as it is, let me tell you, I have not changed. Certainly, I am still 95% invested in mid caps only, right? Just 5% liquid I had, which I have invested in Z, which I discussed about. So maybe I'm little actually. I have to rethink about my strategy for future. And that is why I've decided maybe going forward, I am not going to invest in small cap and mid cap, which are illiquid. Because I want peace of mind. Sorry. Yeah.
No. Vikas Kemani is saying that, look, if you want peace of mind, you should buy insurance companies. And that's the reason why I think he likes ICICI Lombard. So fair point, Vikas. Peace of mind, keep your family safe, keep your house safe. But I have a simple follow-up question. ICICI Lombard, derives a large part of its revenue from auto insurance. And we both know that auto sales are down, and we don't know next 2-3 years what will happen to auto sales. Why do you like ICICI Lombard, which is in general insurance, and they get a lot of business from auto insurance?
So I think, Nikunj, when you look at an opportunity for a 10-year perspective, you cannot, in fact, any 1 year or 2 year downturn is an opportunity. So the way I like ICICI Bank, ICICI Lombard, is that if you look at any company or any investment for 10 years, it has to be a large opportunity size. The player which you are looking at has to be a sort of leading player who can capture this opportunity very well, and the management team has to be very, very strong. So if you see in this case, it's a great brand. In last 15-20 years, they have built a great franchise with the market leadership. They are largest private insurance company in the country. Consistently they have delivered growth in the profitability. ROE profile is very good. They are very diversified in terms of auto, healthcare, marine, fire, and across various products. If you look at insurance market in India is very, very underpenetrated. Still, despite the fact that industry has been growing at 17% over last 2 decades, still the underpenetration is to the extent of 1/3 of the where it could be. So we to that extent, I think market is sort of poised to grow, and this is a player which can continue to capture the large part of the growth story as it comes. If you see consistently in insurance, one of the biggest important factor is how do you manage your combined ratio, the expense ratio and loss ratio. And over last more than a decade, I don't know before that, their combined ratio has been less than 100%. It means whatever premium they collect, and we are in an industry in India is one of the very few countries where you collect cash before cover. So you are collecting premium and your combined ratio is well below the premium collected. So you have currently they have entire 20,000 crore rupees of free float lying with them on which they can earn, right? And this number was, let's say 6-7 years ago, 5-6,000 crore. So this free float keeps on growing. You can make some money, from combined ratios. You can lose some money from combined ratio. I mean your expense ratio. That number is by and large, in and around 100% plus minus 2%. So as long as you keep growing in the industry, your franchise will become stronger. And one of the fact I like about this company is that they have chosen their segments very wisely. As the markets have evolved, they have kind of responded to that very well. And technological, edge they have built in the distribution platform. I mean, they are very, very tech savvy. So I feel, as the market is evolving, even within the auto sector, they will be able to evolve. Like to give you a data point, 80 to 90% of the two-wheelers don't get the insurance done after the first or second year. And they have kind of, innovated a product where by the time you fill your petrol, you can get your reinsurance done of third party. And this is a very detailed distribution model, and they take a leadership in that. So I do believe that, of course, next 1 or 2 quarters could be very, or 1 year for that matter, as the auto sales are down, could be sort of painful. But as you look at, you will see, it can get compensated by the health side, where I think things can pick up. Health side, the penetration is only 10%. Total insurance health premium collected at the industry level 80,000 crore, whereas the total amount of money spent on the medical bill 8 lakh crore. Now this 80,000 to 8 lakh crores of premium collection journey could be over next 10 years. So the way I see is this is probably a sort of banking, private sector banking growth what it was in 2005-06. So can you have another 10 year of run in this industry? So I think you should remain invested into the market leader who has delivered not only a decades of delivery track record, but also very well placed to capture the growth in times to come. So I feel this is, not only sort of giving you growth, but also giving you stability in your, return profile.
So Vikas, are you happy to own the stock for next 10 years? And what will change your investment thesis, which could force you to sell the stock?
So I think, typically I would say that if let us say something has changed at the management level, if something, had changed, in their strategy, which is, so you got to constantly keep on evolving. So far, over last 10 years, management has displayed a great track record of doing, absolutely right things. And in this business, mind you, one risk must keep in mind that there might be some catastrophic event. So there might be a particular year where the combined ratio might go from 100 to 105%, or you could have a loss here because that's the nature of the business. But that's not going to be a consistent. And so far, despite all kind of, risk coming through, they have made the ratio well with it. So It's a great track record, but I would say that if a management change happens, I would be very worried. If a sort of any strategic change happens, which we'll have to keep evolving. But otherwise, I don't see too many risks in the stock, to be very frank.
You know, I must say that we're getting a lot of questions, and a lot of questions are follow-up to our today's webinar chat, and a lot of our existing interactions we've had, let's say with Samir, Manish, or sometimes with Vijayji and Sandeep Sabharwal. Sandeep, I've got a question. I'm going to get a neutral arbitrator here. Which is a better idea between HDFC Life and ICICI Prudential? Because we've got two ideas coming from our panelists here. You have not recommended insurance stocks, so you're in a position to give me a neutral comment.
I didn't recommend an insurance stock because what I saw was that already these were being recommended. So I thought that life insurance is a good space to be in. But then those repetition of ideas was something which I actually wanted to avoid.
But Sandeep, fund managers don't think like this. Everybody recommends HDFC Bank. What is wrong in it?
So I would think that life insurance is a better space in India, frankly speaking, because I believe that general insurance over the next 2-3 years at least will see some pressure on margins. Secondly, I think even both on the industrial side as well as on the auto side, there could be some squeeze. And there is a general belief globally that as we move to EVs, so even in that space, the premium should come down. And as more self-driving cars come up, which is a bit stalled right now. So even as that comes up, we could see that the insurance premiums which these companies can charge could come down. And globally, in fact, if you would have seen, many of the global insurance companies are in fact returning car insurances, etc., to people who own cars because the cars are not being used. That's not in India at this stage, but it could be something which people could appeal for. So I would think that for at least the next 2 years, life insurance is a better space.
Okay, Manish Santalia. You know, I rarely see competition saying good things about competition. Because even though you represent Motilal Oswal Financial Services, you happen to like ICICI Securities.
Yeah, so
Love thy enemies.
no, so you know, I believe that broking again is getting consolidated big time. You know, it's no longer the cup of tea of mom and small broking houses anymore. You know, it's just not possible because the compliance costs are going to be the biggest entry barriers, and you'll have you know, the top 10 players or top 15 players take away a lot of market share. Now, the volume of trades that we are seeing in ICICI, you know, the entire broking platform today is only a fraction of what it could be 10 years down the line. I mean, you know, of course, $2.7 trillion economy, we have lots of numbers to scale, $14 trillion China and so on and so forth. So from that point of view, you know, they have a very good platform in ICICI Direct. You know, it's a brand that they have created for themselves, and it's a non-linear scalable model where costs don't increase in line with revenue. So revenue is going to increase definitely, and costs are not going to increase that much. So you have huge operating leverage. Secondly, I think Zerodha does not really present a differentiated business model in broking. It's not an entry barrier that they have created for themselves. ICICI Direct can have both an advisory model and a do-it-yourself model under the same platform. So yes, the yields are going to come down on broking, but the volume of transactions, depending on whether you require an advice or whether you want to do it yourself, can create a differentiated platform. From that perspective, if you are buying a platform business which is scalable non-linearly, you don't have costs moving up, your return ratios are going to be fantabulous, and you know, numbers in terms of profits can be significantly higher. I would believe a 20% CAGR growth, because the broking industry is getting consolidated, and industries, broking companies which are under the banking platform, they will have a bigger trust factor after the Carvey episode. Plus, they have a cross-sell opportunity in the client base that is there with ICICI Bank. All of them gives a ring-fencing competitive advantage, very difficult for competition to penetrate. That will enable them to clock a 20% CAGR, and they don't require capital. It's a free cash flow business per se. The size of the opportunity is just too big 10 years down the line than what we are today. Maybe it's the next Charles Schwab in the making, who knows? But that's the main reason why I like ICICI.
So while you were talking about ICICI Securities, I just saw Pankaj Murarka and he said, Nikunj, come to me please, because I can tell you that what Policy Bazaar has done to the insurance market, it is pure disruption. Are you not worried about disruption here?
No, but Policy Bazaar doesn't make money. That's the whole point. You got to, I really don't believe in business models that don't make money. I mean, it's just that the funding is coming and, the cost of capital is so low. You have these sort of opportunities. I mean, you can have tons of revenues without earning a profit. I mean, everybody wants everything free or at a discounted price. I am saying that you have created an infrastructure where you can have everything possible. You have a distribution business already there where they are also selling life insurance policies, because broking license is under the ICICI Direct platform. They have a distribution business. You can have a do-it-yourself model. You can have a advisory model. You can have a cross-sell loan opportunity model. So, I mean, it's just not that you can't have a differential. Only thing is ICICI Direct has created a much bigger lead over others because the second highest number of customers after Zerodha, they have closer to, I think, 8 to 9% market share even today. So this will only become better because the industry is consolidating, the competitive advantages, moats are only getting wider due to the compliance costs. It's just not possible now to operate a small set of clients and do with the compliance and the costs involved and run a successful business.
Okay, yeah, I'm getting a lot of questions on Reliance. I'll take with some questions on Reliance, but the next stock which I want to throw it open and we'll share the screen here. And this one is coming Mr. Vijay Kedia's way. Vijay ji, you bought Atul Auto, it became 100x. Yeah. Now you're recommending Bajaj Auto. Bajaj Auto cannot be 100x from here. We are missing that multi-bagger idea from you. Why do you like Bajaj Auto? Aren't you playing it too safe? This is a market for stock picker. You are taking ones when you should identify as 6.
देखो वो दिन अभी ना रहे तो उन बात को आप छोड़ दो. Bajaj Auto, again I am saying I picked up at a lower price because that time market cap was just 55,000 rupees. Company is having 17,000 rupees cash in the books. Okay, and what? And that is again short-term buy. It is not 10 years. Forget about 10 years. I don't know whether I will be able to hold for 10 months or not. So let us. So there is no recommendation and all. Why did I buy Bajaj Auto? For the simple fact that, like everybody is discussing whether whenever this recovery will come, either it would be V-shaped recovery or W-shaped recovery or L-shaped recovery or O-shaped recovery. We don't know about that. I don't think so as on today that index is going to have any V-shaped recovery. Okay, this is what I think. I may be wrong, I don't know. But I will not play on that. I think suppose in some sectors, if any V-shaped recovery comes, then I think two will be the first sector where this is possible. For the simple matter, I will give you one data. Like Italy was completely locked down and the two-wheeler sales fell down 70% in Italy. And in Austria, which was little eased up, and two-wheeler sales fell 15%. But Sweden, which was normal, there was no lockdown or normal lifestyle things were there. There they had two-wheeler had a 15% growth year on year. I am talking about. So I bought in this assumption that suppose if lockdown, they remove lockdown maybe on May or whenever they remove. If any V-shaped recovery will come, so it should come in two-wheeler first, not in Maruti. So that is why I bought. But it's a liquid shares. It's traded in FNO also, as you know. So whenever I will change my mind, I will sell immediately. So there is no commitment, let me tell you.
Now everybody in the panel so far has told me that, look, we are buying stocks, but we bought them, let's say a month ago, 6 weeks ago when markets were lower. So nobody's buying stocks right now. Who's buying stocks right now? Will anybody raise their hand and tell me? Or everybody's waiting for a decline? So Vikas Khemani is only... Manish is also buying stocks. No, what I'm asking is that whatever stocks the panel is recommending, everyone's told me that they bought at lower levels. Sandeep has said he's bought Britannia lower. Vijay is telling me he's bought Britannia, Bajaj Auto at a lower level. Are you also buying HDFC? Have you bought HDFC Life at a lower level, Manish?
Yeah, high level, low level, all levels we have bought because we are not buying for 1 year, 2 years. And even ICICI Securities, we have bought it at 500 plus also, we are buying today also. So there's a commitment to buy at much, higher prices we have already bought and even now we are buying. Because the idea is to hold these stocks for next 5-10 years.
Great point. I'm just trying to bring out points for the benefit of the audience here. Bear in mind, we have 665 live audience on this platform. Other platforms, the number is not there with me, but Facebook question, the speed at which they're coming, it is clearly that things are moving there. Because Kamani, you raised your hand, which means that you were bullish on ICICI Lombard, and at the current price also you continue to remain bullish on ICICI Lombard.
Absolutely. I think when you're buying Nikunj for 8-10 years perspective, you need to keep in. 5%, 10% plus minus really doesn't make sense. Of course, I would want to buy as cheaper as I can, but market give you those opportunities. So that timing tactically somebody can do. But I feel that this stock can give 18-20% CAGR over 10-15 years, and this company can one day become easily, in my opinion, $50-60 billion market cap company. And that's the kind of trajectory you're talking about. So when that is the case, that's your hypothesis. You are not optimizing over 5-10% correction. So I would strongly recommend that one should have in the portfolio from a long term perspective.
Pankaj Murarka, apart from InfoEdge, what have you bought recently, and what are you planning to buy on every decline? Pankaj.
We bought some healthcare names of late. We were owning some of them, but we did buy some of them in the last month or so as well, including names like Syngene, Sun Pharma, and so on.
Okay, so you continue to favor the pharma space. Why do you like pharma, Pankaj? Is it because you think that the medical crisis will force everyone to spend more towards care and cure in terms of a sector? Or do you think it's pure underweightage in pharma, which could be the attractive bit? The point I'm trying to make perhaps on a regular basis is that IT sector, financials have a very large weightage in Nifty. Pharma has a less than 5% weightage in Nifty. So do you think more than news, there's a technical strong tailwind for pharma, Pankaj?
Well, all those factors are there, but I think more importantly, we're buying them with a slightly more longer term view, which is like at least 5-7 years or maybe longer. Clearly, I think when it comes to pharma, the business itself is very resilient and is immune to economic shocks. So even in an environment like this, where all of us are locked down or working from home, you don't stop consuming medicines if you fall sick. Yeah. So it's a business which is immune to economic cycles and economic shocks. So that effectively tells you about the resilience of the business. More importantly, I think India's chemistry skills are probably one of the best in the world. So the US generic space had gone through a huge, should I say, price correction over the last 3-4 years. But now we are at the fag end of it, and more importantly, some of the companies, for example, Sun Pharma, we have ownership there, and we like that. I think they've made significant investments in their business over the last 5 years, over $1 billion plus, to transition their business from generic to specialty generics or branded generics. Sun Pharma is the first Indian company to make such significant investments. I think the Sun Pharma of future over the next 3-5 years will be very different than the Sun Pharma that it has been on the past. They've always led. They've been the leaders. 15 years back when they went to US, it was perceived as a generic company. It was perceived to be a high risk bet, and what we've seen is essentially they emerge as
What's the price target for Sun Pharma?
Sorry?
What is your price target for Sun Pharma?
Near term, probably, if I look at from a 1 year prism, it could be probably around 550 or something like that, because the stock is valued about 25%. But more importantly, I think the view here is, our view is that it can keep compounding its earnings at about 20% CAGR for the next 5 years, 7 years. So eventual price targets could be much higher.
Okay, we've already done about 7-8 ideas from our experts, but before I roll it over to some more stock ideas, I'm getting a lot of questions on 2 stocks here. I want to make this webinar all about interactivity, all about trying to address answers and questions for people who've logged in. That's the whole purpose. And I must, compliment our 5 horsemen here, that in this kind of a time when stock picking is considered to be a dirty word, they've come out and they are really talking and sharing their wisdom that how every time they've invested in a crisis, whether it's 2001, 2008, Vijayji goes back to 1992, not a reminder of his age, but reminder of his experience here. Sandeep Sabharwal, has this lovely tweet that he was the fund manager of the year a couple of years ago. Manish and me have been personal friends for 20 years. Pankaj, well, I know him from where he had hair on his head. But So that's the experience which is there on in this panel, that they've seen many of these crises, and they know that typically when market crises happen, if you keep patience, if you stick to fundamentals, if you don't panic, this market will always create opportunity. So Sandeep Sabharwal, let's discuss Bajaj Finance. Yes, Bajaj Finance. Most halo stock is down 50%. Manish Sonthalia, I'm coming right back to you because I know you have a view on Bajaj Finance, but I want to talk to Sandeep Sabharwal. He told me a year ago, भैया बहुत महंगा है, संभल के रहना, फंड मैनेजर की मत सुनना. Sandeep Sabharwal.
So I think if the economy of India has to progress, high quality financials have to do well. So if high quality financials have to do well, then among the highest quality financials will be Bajaj Finance. So if you get it cheap enough, I think you should buy. If when people can say no issues with the stock, then you need to be cautious. When people can see so many issues, then you need to be slightly brave. So I would say that I wouldn't have touched Bajaj Finance by a large pool at 4,000, 4,500, anywhere near that. But at the prices at which it is even today, although my near-term view on the markets is negative, I think the markets could give up gains from where they are. I would still think that people who still buy Bajaj Finance even at these prices could see a 20% downside possibly as the markets give up some of their gains, but eventually they'll make money. So this is the time in India for large financials who don't have balance sheet issues of the past, or large banks, because what we are going to see with small size financials is what happened to infrastructure after the 2009-10 boom. We will see smaller financial stocks just keep on grinding down. This is not the time to get into them. This is the time to stick to quality, and Bajaj Finance finally is quality.
Okay, Manish Sonthalia, I don't need to come back to you. I guess Sandeep has really done all the hard work in defending that why you are also owning Bajaj Finance. But because Khemani, you've been talking about chemicals. You've been talking about why specialty chemical is a good space to be in. You've liked IT industries in the past, but walk us through that. Because of crude and the fact that crude prices have collapsed, how will life and the business environment change for a chemical or a special chemical company like Aarti Industries, which directly or indirectly is dependent on crude?
I think, Nikunj, the specialty company like Aarti is very well, hedged against that. First of all, let me build, why I like Aarti. Aarti is basically a company which is largest specialty engine chemist to this specialty chemical company. They've grown over last 10 years. Their revenue at 13%, profitability at 20%, and over last 15-20 years, they've been consistently delivering. And they've built a moat, which is not easy to displace. So they're very well diversified in terms of, geography, customer base, product, user industry. Today, they supply to 200 countries, work for 400 customers. And, so it is a significant moat. And these kind of companies, don't get built overnight. They get built over 30 years. And as a lot of, companies are trying to diversify away their procurement from China to India, this company also stands to benefit from that trend. So I think, and that's a part of that. Now, coming to your crude question, I think, most of the contracts, or large part of the contracts are always passed through. So it's never based on, depends on the, whatever the input price is all benchmark. So they don't carry any risk or difference because of the crude price. In fact, falling crude price helps to them to the extent of improvement in the working capital. But I'll tell you one of the unique part about this company. Recently, they got 3 contracts in the CRAMS, and where a foreign company came, gave them money, gave them technology, and gave them order. Now, where does it happen? Where a customer invests for your capex, gives you technology, and also gives you take or pay contract. Now, this is the kind of capability company has. The only reason when they can give, when company has a capability to manage, manufacture, and deliver to them as per the standards of the global company's requirement. So like this, they have got contracts. Recently, they got another contract with a 40% EBITDA margin for a 10-year take or pay contract. So this is the kind of profile or capability or competency this company has built over the last 30 years, and it is very difficult to displace something like this. So
Are you happy to own it for 3-4 years, Vikas?
I'm happy to own it for at least next 5-7 years. I feel this trend of diversifying the base from China to India is going to accelerate, and this company obviously has displayed already and can actually, continue to do well. I feel this company has a potential, in my opinion, to become an $8-10 billion market cap company. By the way, in 2012, the market cap of the company was 400 crores.
Vijay, you are a value stock picker, and I was waiting for some questions on the value stock picking style. So Vijay, the question is that stocks like HPCL, BPCL, BEL, largely PSUs are very cheap. We don't have a debt. They are owned by government. Why are you not buying them? Because in 2001, 2002, when you bought PSU stocks, you made money. In this market fall, why are you buying a Bajaj Auto or a Z, but why not, BPCL or HPCL? Or any, for that matter, any PSU?
Because I don't trust what government is going to do tomorrow. They will merge IDBI with LIC and LIC with GIC and GIC with this HPCL with ONGC and all. And let me tell you, like all my these friends and all, I'm not a fund manager. I'm just individual small shareholder. I have got limited fund. I have got limited portfolio. Not necessary that I have to buy shares from every sectors. So, and as I said that I'm not holding much of cash, just 5% cash I am holding. So whatever earlier stocks, as you know, just Sudarshan Chemical and all, I'm holding and I'm happy with them. So I don't need to find another story.
Okay. Sandeep, your next stock is Havells. You are playing it dangerously, my friend. Britannia, Havells. Value. Where is value in them?
So the thesis remains the same. I believe that, now just to repeat myself, I believe the Indian economy is entering into a long-term slow growth phase in which consumption will still do well because people have aspirations to consume. As income levels go, people will consume more, and you have to play the consumer game. Now in that, you have to see which are the companies which have got strong managements who have captured opportunities in the past and who can capture opportunities as consumer tastes change and capture those to grow. So I think Havells also fits in that category. Current market capitalization is around 25,000 crores. They are available, they are present in a large swath of areas which include products which go into housing like switch gears, cable, wireless, etc., right to consumer products where they have built very strong brands. Many of their products actually sell at a premium to brands which were earlier established, and that is something which I like. So they have made some mistakes like Lloyd acquisition, etc., which has hurt their market capitalization and perception. But I think that's something they can get over. So I think given the way consumerism could grow over the next 10 years. So when we are talking about 10 years, we don't need to look at companies. We can't look at companies where we have to look at them every day or every 6 months to see what's happening, what's not happening. We have to take a longer term view. So with a longer term view, can this 25,000 crore market capitalization company be maybe 1,50,000 crores, 2,00,000 crores market capitalization company over the next 10 years as they grow inorganically and organically both? I would think so. So I think that's my thesis for this talk.
Okay. Pankaj, we are talking about what to buy, but money is made if you also don't do mistakes and you don't buy stocks or businesses which eventually could become weak, and if you end up buying mediocre businesses. All of us always ask, kya lene ka? Let me rephrase my next question, Pankaj, to you. What will you not buy in this fall? What would you say, look, price has come down, but I will not be tempted to buy it because I don't believe in that business, that sector, and post-COVID, that sector will get disrupted. Pankaj.
There are pockets of markets, I think, where there is still high degree of exuberance or market are pricing in the growth expectation that market are pricing is unlikely to be met. And I have a bit contrarian approach to this. So my view is staples are extremely rich and expensive. If in the context of the growth they are likely to deliver, you look at Lever, last 15 years, Lever has done a single digit revenue growth and about 12% profit growth, 12 or 13% profit growth, I think, until the year before that. Now, in most of the categories in which Lever exists, they are by and large significantly penetrated, except for the last acquisition they made, which is the Glaxo acquisition, whereby they got into some new categories. But yet it will not move needle on Lever scale, meaning the impact will not be very significant. So even if I presume the best case growth for lever over the next 15 years is the same as the last 15 years, for an investor wanting to generate 15% CAGR returns out of lever over the next 15 years, the PE multiples have to expand by 50% over the next 15 years, because the 50% of returns will have to come from PE multiples. Earning growth is about just about 10-12%. So I think there Staples does offer high degree of safety in environment in terms of the cash flows and resilience of the business, and in environments like this where there is a high degree of fear and there's high degree of disruption, they look like a safe haven. But from a returns potential from a medium term to long term perspective, I think they'll disappoint.
Okay, Vijay Kedia, the question on popular demand, few people have asked me, I'm not pick up the one on the screen. Akshay wants to know, Mr. Okay, Vijay, is my voice reaching you?
Yeah, no, some background noise is coming. Yeah, I can hear now. Yeah, please. Okay. It's okay now.
I'm picking a question from the chat. 3 people have asked me. Mr. Kedia has given 2 stock ideas where he says that these are not for 10 years. If Mr. Kedia has to buy 1 or 2 stocks for next 10 years or at least 5 years, where will he buy or what will he continue to hold?
No, I will continue to hold my old stocks like Sudarshan Chemical and Repro India and others, whatever I am holding. Those I may continue to hold. You know, let me tell you, currently I'm in a confused state of mind. Okay, I'm not very confident about this rally, whatever is happening in the market. I don't think that index is going to cross. This is my personal view, that index is going to cross 10,000 or 10,500 in a hurry. So right now I'm confused. But having said that, maybe I would continue to hold my Sudarshan Chemical or Repro and all these shares, maybe for maybe some time. I don't want to say about 10 years and all. You had asked me earlier so many times, and I always told you, okay, I don't mind holding them for 5 years or 10 years, you know. Again, some background noise is coming. Okay, but currently I need some time. Let me see that how this market behave in next 3 months to 6 months. Then I will decide. So I can tell you that maybe mentally I am weak and you are asking me to run a marathon. So I would refrain from making any commitment or any. So I would say let us watch the game. Let us see what happens in next 3 months.
Vikas Kemani is shaking his head. I can see you, Vikas Kemani. The minute Vikas hears the word marathon, he says, look, come to me. Okay. If we are in a marathon, Vikas, and if the starting point is 2020, and if the ending date of the marathon is 2030, what stocks you would like to run with? You can give me 1, 2, 3, whatever you like. Just give me the names.
I think I've already given you 2. ICICI Lombard and Aarti. Both of them are, I think, phenomenal franchises. And I think I would, if I have to add more, I think I would definitely look at Eicher Motors, which again I feel is a phenomenal franchise and run by a great management team and a great balance sheet, great product. So right now, of course, it has corrected. It has become almost 40% of its peak price. So to that extent, offers a great opportunity. It has not run up, but I'm reasonably sure that as the environment turns out, as the business changes, it can create a significant opportunity. The idea is to look at businesses which are basically well-run franchisees by well-run management team, and valuations are not crazily out of whack for you to kind of get a wrong entry at the wrong entry at the wrong price. That's the only thing you have to keep in mind. So I would say that some of these names can really compound, and we have very high conviction of them, and we own all of them in our funds. So I must put that disclosure, and made personally also. So we think that they can compound for a long period of time, in time to come, and my period would be for each of them 10 years.
Okay, Manish, I would wrap it up with one question. It's on ITC. Classic underperformer, classic company which gives you everything which a fund manager looks at: no debt, good moat, a shield around tobacco business, FMCG business is also looking okay. Why is ITC underperforming?
Yeah, so I'm a buyer in ITC as well. So it's all due to this ESG concept, etc. But my simple argument is that the color of money remains the same. So the fact remains that ITC for FY20 will make something like 15,000 crores of profit. The management is on record to say that they are going to pay out 85% of these profits as dividend. So dividend yield works out to be 6.5%. And the FMCG business is scaling up well, at least in the segments where they are category leader. Cream biscuits, bingo, and atta. They are 30% market share. All their capex has gone away. Hotels capex is behind us, so it's more about free cash flow. cigarette business really doesn't require that much of capex. So valuations has just come off because of this ESG thing. But my simple argument is that India today consumes less cigarettes than even Bangladesh. Bangladesh is 1/10 the population of what India is. So the growth factor as far as tobacco is concerned in India is a long way to go. You know, if the Indian government was to allow BAT to increase its stake, I mean, they would jolly well do it at much higher levels than what it is today. So according to me, it's a deep value stock, a superior high quality franchise, free cash flow generating machine. They have not, ITC has really not delivered returns for 5 years, but there have been many instances in the past where companies have not delivered returns for 5 years. It's supposed to be naysayer stock, but I am a buyer at these prices because I believe that the profits earned are genuine and because it translates into higher cash flows in the form of dividends. Your growth factor is also going to be there. Of course, cigarette volumes are going to be a dampener, but nonetheless, price hike pass-through will ensure that the company at least does a 10% growth. How can a company with a 10% growth have just about a less than 15 prices to earning multiple? I find it hard to believe. So that's why, according to me, it's a great buy at these prices.
Okay, now I'm going to ask one simple question to everyone here and just hear me out. Are you guys ready for the last question? This was, I'm going to come through everyone. I'm going to start with you, Sandeep. For next 1 to 3 years, in someone's asset allocation, which asset you should remain overweight on, gold, bonds or equities? Just one answer. I think Sandeep is on mute. Sandeep, you're on mute. I think you'll have to unmute yourself.
Manish first, I think he's unmuted.
Okay.
Yeah, now I'm on.
Yes.
So I think this question you need to rephrase in terms of, see, because there is one asset which I think will do very well, but I can't put 80% of money in that. So which I think is gold. I believe that given the kind of money which has got printed globally, once I think this money is going to chase some asset and that asset is going to be gold. I believe that gold is going to be a huge outperformer over the next few years. So I always keep on buying gold, contrary to conventional wisdom. But I would think that gold will be.
Are you saying this because you're from home and your wife is hearing the webinar that you're buying gold? Or you genuinely mean that?
I don't know whether she is hearing. She might be, but I think I'm not sure. But I keep on buying gold because I think it's a good asset allocation. Because earlier we used to buy real estate. Real estate is a dud investment in India now. I think gold is much better.
Okay. Pankaj, for 1 and 3 years, which is one asset you would like to remain overweight on?
Yes, undoubtedly equities. 1 year is a slightly tricky one because in the short term, markets are more like a toss of a coin. But I'll still go with equities.
Because Khimani, you are a marathoner. You have to pace when you are running a long marathon, right? And pace starts at 0.1. So the first year, where will you remain overweight? And next 3 years, where will you remain overweight?
I think undoubtedly equities, because if you see, we are just in the middle of a crisis, and we'll come out of this crisis in the next 1, 2, 3 years. And we have seen every time we come out of a crisis, equities have delivered significant return. March 2009 to October 2010, you see index itself gave almost 180% return. Right. So I feel from 1 to 3 year perspective, equities will be sort of a great asset class to own. I also do agree with Sandeep that gold will also perform well. So you should have some allocation, but overall perspective, I think equity stands out by far the best.
Vijay ji, 1 year and 3 years.
सर आपने एक बोला ना एक जवाब देने का है तो सर मेरा ब्लड ग्रुप जो है वो पॉजिटिव क्या ई है अगर मेरे पास में इक्विटी अगर नहीं होएगा तो शायद मेरे को जीने में कोई आनंद नहीं आएगा मेरा लाइफ के अंदर में तो रिटर्न आए या नहीं आए वो है ना कि तू हाँ कर या ना कर तू है मेरी किरण तो अपना तो इक्विटी जिंदगी जब तक जिएंगे वही रहेंगे रिटर्न जो आना नहीं आना वो ठीक है वो ईश्वर का काम
तो विजय जी ने बोला E, I will say A, B, C, D, E. A is for asset allocation, B is for bonds, C is for credit, D is for debt, E is for equity. Stick to your asset allocation. That is, I think, very, very important. That's the right message we want to take sure. But, we started late only because of technology. But thank you for your patience. I think patience is the key to make money in this kind of a market. But Manish, don't nod your head. The main part of the show is left because Mr. Kedia wrote a poem in the bull market. By the time the poem ended, it became a bear market.
Yeah.
So before we end this webinar, Mr. Kedia, a bull market poem, which you'll have to recite in a bear market now.
तो सुनो, चलो मैं अभी बताता हूँ। वो एक जो पोएम पुराना, नया तो कुछ लिखा नहीं, अभी तो आवाज ही नहीं आती है यार, प्यास नहीं लगती है, खाना नहीं भाता है, क्या बात कर रहे हो यार। घर में बैठे बैठे बीवी भी पहले वाइफ मालूम है, निकुंज भाई पहले बोलती थी बीवी कि घर कब आओगे, अभी बीवी बोलती है घर से कब जाओगे, तो अभी तो क्या करे। तो एनीवे मैं पुराना ही वो पोएम सुनाता जो लिखा था। फॉरगेट अबाउट द लास्ट बुल मार्केट, लुक फॉर न्यू शेयर्स एंड न्यू टारगेट। इट्स नॉट दैट, क्या है, इट्स नॉट दैट फर्स्ट टाइम वी गॉट सच पेन, we have recovered in the past, we shall recover again. Look back, analyze and find out your mistake. What's the lesson in it and what's your take? Get up, get ready, forget this pain. Market will give another chance again. Market will give another chance again.
All right, that's an optimistic way to end our today's webinar. Thank you very much. And on behalf of everyone, I want to remind people who are watching us live, people who will watch us little later on different platforms, that please do your homework. Standard disclosure, these are stocks where our panelists have a vested interest. They own them, they are buying them, and they have a view which could be an vested interest. So please do your disclosures. That's a standard statutory disclosure which I want to share before we end. Thank you very much. Have a great evening. And it was a very engaging 1 hour, actually 1 hour plus, didn't realize the track of time. So thank you for your patience and thank you for your time.
Thank you,
Thank
Nikunj,
you.
for having us.
Thank you, everybody. Thank you, viewers. Thank you.